All right, Andrew John here, and I need you to lock in for the next few minutes. What I'm about to share with you is not speculation, it's not theory, and it's not another mainstream media narrative designed to keep you calm while the system quietly breaks. This is about a critical market dislocation happening right now in the overnight lending market, the repo market, and it's seizing up in a way that should terrify anyone who understands how modern finance actually works. On the evening of February 11th, 2026, the overnight general collateral rate, that's the rate at which major financial institutions lend cash to each other secured by Treasury bonds, spiked to 6.8%. That might not sound dramatic until you understand that just 48 hours earlier, that same rate was sitting at 4.3%. We're talking about a 250 basis point move in the most systemically important short-term funding market on the planet in less than 2 trading days. This is not normal volatility. This is a liquidity seizure. And if you don't understand what that means, here's the bottom line. The plumbing of the financial system, the mechanism that allows banks, hedge funds, and broker-dealers to fund their operations overnight, is breaking down. And when the repo market seizes, nothing else works. Not the stock market, not the bond market, not the credit markets, nothing. This is the kind of signal that preceded the 2008 financial crisis, the 2019 repo crisis, and every major liquidity event in modern financial history. Over the next 25 minutes, I'm going to walk you through exactly what's happening in the repo market right now, why this matters more than anything you'll see on CNBC, and most importantly, what you need to do immediately to protect your wealth and position yourself for what's coming. By the end of this video, you'll understand the mechanics of this breakdown, the historical parallels that prove this is not a one-off event, and the 3 asymmetric plays that could not only preserve your capital, but multiply it during the chaos ahead. So turn off the distractions, grab a notepad, and let's break this down step by step because the clock is ticking. Before we dive into the current crisis, you need to understand the foundational framework that governs every major liquidity event in financial history. I call this the collateral chain framework, and it's the hidden architecture that keeps the entire modern financial system functioning. Most people think banks make money by taking deposits and making loans. That's kindergarten-level economics. The reality is that modern banks operate on what's called rehypothecation, which means they take collateral, typically Treasury bonds, and they use that same collateral multiple times across different transactions to generate leverage and liquidity. Here's how it works. A hedge fund owns $1 billion in Treasury bonds. They don't want to sell those bonds because they're earning interest, but they need cash to make other trades. So they go to a major bank and they enter into a repurchase agreement, a repo. The hedge fund gives the bank the Treasury bonds as collateral and the bank gives them cash. The agreement is that tomorrow the hedge fund will buy back those bonds at a slightly higher price. That price difference is the repo rate, essentially the cost of borrowing overnight. Now here's where it gets interesting. The bank that just received those Treasury bonds as collateral doesn't just sit on them. They immediately turn around and use those same bonds as collateral to borrow cash from another institution, maybe a money market fund or another bank. That second institution might then use those same bonds again as collateral for another transaction. This is rehypothecation, and it means that a single Treasury bond can support 5, 10, or even 20 different transactions simultaneously. The entire system is built on the assumption that collateral is always liquid, that you can always convert it back to cash instantly, and that the chain never breaks. But when the repo market seizes, when the overnight rate spikes because institutions suddenly don't trust each other or don't have enough cash to lend, the collateral chain freezes. And when that happens, institutions that were relying on overnight funding to meet their obligations suddenly can't access cash. They're forced to sell assets into a falling market. Those sales drive prices down further, which makes the collateral worth less, which triggers more margin calls, which forces more selling. This is a liquidity death spiral, and we've seen it before. The thesis of this video is straightforward. The repo market is flashing the same warning signals we saw in September 2019 and September 2008. The difference is that this time the Federal Reserve has less room to intervene because rates are already elevated, their balance sheet is still bloated from previous interventions, and the underlying stress in the system is deeper. This is not a temporary blip. This is the beginning of a structural breakdown that will force a policy response, and that response will determine whether we enter a deflationary collapse or an inflationary meltdown. Either way, the wealth transfer is coming, and you need to be positioned correctly. Let's ground this in history because the pattern is undeniable. The first parallel we need to examine is the liquidity crisis of 2008, specifically what happened in the repo market in September of that year. Most people remember Lehman Brothers failing, but the mechanism that actually brought down the global financial system was the repo market freeze. In the weeks leading up to Lehman's bankruptcy on September 15, 2008, repo rates started spiking. Institutions that had been lending to each other overnight at minimal spreads suddenly demanded 200, 300, even 400 basis points more because they didn't know which banks were holding toxic mortgage-backed securities. When Lehman filed for bankruptcy, the repo market essentially shut down. Nobody would lend to anyone because counterparty risk became unquantifiable. Hedge funds that relied on repo funding to finance their portfolios were suddenly unable to roll over their overnight loans. They were forced to liquidate positions at fire sale prices, which crashed equity markets, corporate bond markets, and even Treasury markets temporarily. The collateral chain broke, and the entire system seized. The Federal Reserve's response was unprecedented. They launched the term auction facility, the primary dealer credit facility, and ultimately quantitative easing, where they began buying Treasury bonds and mortgage-backed securities directly to inject liquidity into the system. They dropped interest rates to zero and kept them there for 7 years. The lesson from 2008 is clear. When the repo market seizes, the Federal Reserve will do whatever it takes to unfreeze it, even if that means creating trillions of dollars out of thin air. But here's what most people don't understand. The intervention in 2008 only worked because the system was fundamentally solvent. Banks were illiquid, not insolvent. There was a liquidity problem, not a solvency problem. Today we have both. The second historical parallel is the repo crisis of September 2019, and this one is even more instructive because it happened after the Federal Reserve had supposedly normalized policy. In mid-September 2019, the overnight repo rate spiked from around 2% to over 10% in a single session. 10%. For context, that's higher than the rate during the 2008 crisis. The spike was so severe that the Federal Reserve was forced to intervene within hours, injecting tens of billions of dollars into the repo market to bring rates back down. The official explanation was that it was a confluence of technical factors. Corporate tax payments drained reserves from the banking system, and Treasury auctions absorbed additional liquidity. But the real reason was deeper. The banking system no longer had excess reserves to lend. The Federal Reserve's balance sheet runoff, the quantitative tightening they had been doing since 2017, had drained so much liquidity from the system that banks didn't have enough cash to lend in the repo market even when they wanted to. The Fed's response was to restart repo operations, injecting $50 to $75 billion per day into the market. And within weeks, they quietly restarted quantitative easing, calling it not QE to avoid admitting they had made a policy error. The lesson from 2019 is that the modern financial system is so fragile, so dependent on continuous liquidity injections, that even a small reduction in Federal Reserve support causes the repo market to malfunction. And once it malfunctions, the Fed has no choice but to intervene. Now let's bring this into February 2026 and break down exactly what's happening right now. The overnight general collateral repo rate spiked to 6.8% on February 11th. This is not a one-day anomaly. This is the third spike we've seen in the past 6 weeks. On January 8th, the rate briefly touched 6.2%. On January 23rd, it hit 6.5%, and now we're at 6.8%. The trajectory is clear. The spikes are getting larger and more frequent. This tells us that the underlying stress is not resolving, it's accelerating. Now, why is this happening? There are 3 interconnected drivers, and you need to understand all of them to see the full picture. First, the Federal Reserve's balance sheet. After the aggressive quantitative tightening campaign that ran from 2022 through mid-2024, the Fed's balance sheet has shrunk from a peak of $9 trillion to just under $7 trillion. That's $2 trillion of liquidity drained from the system. Now, $7 trillion still sounds like a lot, but here's the problem. The banking system has grown accustomed to operating with massive excess reserves. When those reserves shrink, even by a small amount relative to total assets, the marginal impact on overnight funding markets is enormous. Banks that used to have hundreds of billions in excess reserves to lend now have much less, and they're more cautious about lending it. Second, Treasury issuance. The United States government is running deficits of over $2 trillion per year, and to finance those deficits, the Treasury is issuing record amounts of debt. In the first quarter of 2026 alone, the Treasury issued over $500 billion in new bonds. Every time the Treasury auctions bonds, primary dealers, the big banks that are required to buy those bonds, have to come up with cash. And where do they get that cash? The repo market. They borrow it overnight using their existing Treasury holdings as collateral. But when multiple large auctions hit the market in a compressed time frame, it drains cash from the repo market temporarily, which causes rates to spike. Third, and this is the mechanism that nobody's talking about on mainstream financial media, hedge fund leverage. Hedge funds have rebuilt their leverage to levels not seen since 2007. They're using repo funding to finance everything from Treasury basis trades to equity long-short strategies to credit arbitrage. These are sophisticated trades that rely on tiny spreads, but they require enormous amounts of leverage to be profitable. When repo rates spike, the cost of that leverage goes up, which makes the trades unprofitable. If rates stay elevated, hedge funds are forced to unwind positions, which means selling assets, which drives prices down, which triggers margin calls, which forces more selling. This is the liquidity death spiral I mentioned earlier, and we are in the early innings of it right now. Let me give you a specific example to make this concrete. There's a trade that hedge funds have been running for years called the Treasury basis trade. Here's how it works. You buy a Treasury bond in the cash market, and simultaneously you sell a Treasury futures contract. The bond and the future should trade at almost the same price because they represent the same underlying asset. But because of technical factors in the market, there's often a small spread between them. Let's say the spread is 10 basis points. That doesn't sound like much, but if you can leverage that trade 20 to 1 using repo funding, you can turn a 10 basis point spread into a 200 basis point return. This trade has been enormously profitable, and it's been run by some of the largest hedge funds in the world. But here's the catch. It only works if repo funding is cheap and stable. If overnight repo rates are sitting at 4%, your cost of leverage is manageable. But if repo rates spike to 6.8%, your trade is suddenly losing money. And if the spike is sustained, you're forced to unwind the position. Now multiply that dynamic across hundreds of hedge funds running similar trades with trillions of dollars in notional exposure, and you start to see why a repo market seizure is so dangerous. It's not just one trade or one institution, it's a systemic unwind that cascades through the entire market. According to data from the Office of Financial Research, hedge fund leverage measured by gross notional exposure divided by net asset value has climbed to 8.5 to 1 as of the fourth quarter of 2025. That's the highest reading since 2007, right before the financial crisis. And the majority of that leverage is financed through the repo market. When repo rates were stable at 3 to 4%, this leverage was sustainable. At 6.8% and climbing, it's not. The math simply doesn't work anymore. Now let's talk about the quiet mechanism that makes this even more dangerous. The Federal Reserve has a tool called the Standing Repo Facility, which was created after the 2019 crisis to provide a backstop for repo market dysfunction. The idea is that if repo rates spike, eligible institutions can borrow directly from the Fed at a predetermined rate, currently set at 5.5%. This is supposed to act as a ceiling on repo rates because no institution would pay more than 5.5% in the open market when they can borrow from the Fed at that rate. But here's the problem. The overnight repo rate just hit 6.8%, which is 130 basis points above the standing repo facility rate. That should be impossible. If institutions can borrow from the Fed at 5.5%, why are they paying 6.8% in the open market? There are only two possible explanations, and both are alarming. The first explanation is that institutions are hitting their borrowing limits at the standing repo facility, and they need more cash than the facility can provide. The Fed caps borrowing at the facility to prevent institutions from becoming overly dependent on it. If institutions are maxing out their borrowing limits, it means they have a funding gap that cannot be filled by the Fed's backstop. That's a liquidity crisis by definition. The second explanation is that some institutions cannot access the standing repo facility because they don't meet the eligibility requirements, or because they're worried that borrowing from the Fed would signal weakness and trigger a loss of confidence among their counterparties. This is the stigma problem that plagued the Fed's emergency lending facilities during 2008. Institutions would rather pay elevated rates in the private market than be seen borrowing from the Fed because they're afraid it will be interpreted as a sign of distress. Either way, the fact that repo rates are trading significantly above the standing repo facility rate tells us that the Fed's backstop is not functioning as intended. The market is breaking through what was supposed to be a ceiling, and that means the stress is deeper than the Fed's existing tools can address. So, what are the three asymmetric plays in this environment? Let me be very clear about this. The first play is short-duration Treasury bills as a temporary safe haven with immediate liquidity. When the repo market seizes, institutions flee to the safest, most liquid assets available. That's short-duration Treasury bills, 3-month T-bills, 6-month T-bills. These are effectively cash equivalents that earn interest and are backed by the full faith and credit of the United States government. Now, I'm not saying T-bills are a long-term wealth preservation strategy, especially in an environment of financial repression and negative real rates, but in the immediate term, when liquidity is scarce and volatility is spiking, T-bills provide a place to park capital where you can access it instantly without taking duration risk or credit risk. The asymmetry comes from the fact that when the repo market seizes, T-bill yields actually drop because everyone is buying them as a safe haven. So you get price appreciation on top of the interest income. During the 2008 crisis, 3-month T-bill yields briefly went negative as institutions piled into them. During the March 2020 COVID panic, T-bill yields dropped from 1.5% to 0.05% in a matter of days. This is a flight to quality dynamic, and it happens every single time there's a liquidity crisis. This is a tactical position, not a strategic one, but it's critical for maintaining liquidity while the dust settles. You want to keep 20 to 30% of your portfolio in short-duration T-bills or money market funds that invest exclusively in T-bills so that you have dry powder when opportunities emerge and you're not forced to sell other assets at fire sale prices. The second play is physical precious metals, gold and silver, held outside the banking system. This is the ultimate asymmetric hedge in a liquidity crisis because gold and silver have zero counterparty risk. They are not someone else's liability. When the repo market seizes and the collateral chain breaks, financial assets that you think are safe, like money market funds, brokerage account cash balances, even Treasury bonds held in street name, are suddenly at risk because they're part of the rehypothecation chain. If your broker or custodian is relying on repo funding to meet their obligations and that funding disappears, you have counterparty risk even in assets you thought were completely safe. Physical gold and silver eliminate that risk entirely. When you hold physical metal in your possession or in a fully allocated segregated vault that you control, there is no intermediary, no rehypothecation, no collateral chain. It's final settlement outside the financial system. Now, here's why this is asymmetric. During the 2008 crisis, gold went from around $800 per ounce in October 2008 to over $1,900 by September 2011. That's a 137% gain while the stock market was still recovering and bonds were yielding nothing. During the 2019 repo crisis, gold rallied from $1,450 to over $2,000 within a year. The pattern is clear. When liquidity seizes and trust in the financial system erodes, capital flows into monetary metals. And right now, gold is trading around $2,850 per ounce. In real terms, adjusted for inflation, that's still 30% below its 1980 peak. Silver is even more compelling. The gold to silver ratio is currently sitting around 88 to 1, meaning it takes 88 ounces of silver to buy 1 ounce of gold. The historical average is closer to 60 to 1, and during periods of monetary stress, that ratio has compressed to 30 to 1 or even lower. If we see a sustained repo market crisis and a Federal Reserve policy response that involves restarting quantitative easing or dropping rates back to zero, silver will outperform gold on a percentage basis because of its smaller market size and its dual role as both a monetary metal and an industrial commodity. The move here is simple. Allocate a meaningful portion of your liquid net worth, and I'm talking 15 to 25% minimum, into physical gold and silver. Not ETFs, not futures, not unallocated pool accounts. Physical metal that you take delivery of or store in a segregated allocated vault outside the banking system. You want to work with reputable dealers like APMEX, JM Bullion, or SD Bullion. You want to focus on sovereign coins like American Eagles, Canadian Maple Leafs, or Austrian Philharmonics because they have lower premiums and higher liquidity than generic rounds or bars. And you want to avoid numismatic coins or collectibles because you're paying a premium for rarity rather than metal content. The third asymmetric play is precious metals mining equities, specifically the senior producers with Tier 1 assets, strong balance sheets, and low political risk. These are leveraged plays on the underlying metal price, and historically in a bull market for gold and silver, the miners outperform the physical metal by a factor of 3 to 5. Here's the math. A gold mining company with an all-in sustaining cost of $1,400 per ounce is currently generating around $1,450 per ounce in free cash flow at a $2,850 gold price. That's a decent margin, but nothing spectacular. Now, if gold moves to $4,000 per ounce, which is entirely plausible in a scenario where the Fed restarts QE and real interest rates go deeply negative again, that same miner is suddenly generating $2,600 per ounce in free cash flow. Their profitability doesn't just double, it increases by a factor of 4 or 5, and the stock market values these companies on multiples of free cash flow. So a doubling of the gold price can easily result in a tripling or quadrupling of the stock price. Silver miners show even more operating leverage. A silver miner with an all-in sustaining cost of $18 per ounce is generating about $14 per ounce in free cash flow at current silver prices around $32. If silver moves to $60 or $70, which happened as recently as 2011 and is well within the realm of possibility, given supply-demand fundamentals and monetary dynamics, that same miner would be generating $42 to $52 per ounce in free cash flow. That's a tripling or quadrupling of cash generation, which translates to explosive stock price appreciation. The key is to focus on quality. You want producers, not explorers. You want companies with multiple operating mines, low-cost structures, and jurisdictions with stable rule of law. You want balance sheets with manageable debt and management teams with a track record of capital discipline. The names that fit this profile are well known: Newmont, Barrick Gold, Agnico Eagle Mines, Franco-Nevada, Wheaton Precious Metals. These are not speculative penny stocks. These are multi-billion-dollar companies with institutional followings, and they will be the primary beneficiaries when capital rotates into the sector during a liquidity crisis and Fed policy pivot. Now let's talk about the signals that tell us this repo market stress is not resolving and is likely to escalate. The first signal is the frequency and magnitude of the rate spikes. We've now had 3 significant spikes in 6 weeks, and each one has been larger than the last. This is not random noise. This is a system under increasing stress. The pattern of higher highs in repo rates indicates that the underlying drivers, reserve scarcity, Treasury issuance, and hedge fund leverage, are not being addressed. They're getting worse. The second signal is the Federal Reserve's response, or lack thereof. After the 2019 repo crisis, the Fed intervened immediately with overnight repo operations and within weeks restarted balance sheet expansion. This time, they have been notably silent. There have been no announcements of new repo facilities, no indication that they're prepared to inject liquidity, no emergency Federal Open Market Committee meetings. This tells me one of 2 things. Either they believe the stress is temporary and will resolve on its own, which would be a catastrophic misjudgment given the historical pattern, or they are waiting for the crisis to worsen before they act because they need political cover for another round of intervention. The Fed is acutely aware that restarting quantitative easing or expanding emergency lending facilities will be viewed as admitting policy failure and could reignite inflation concerns, so they're waiting for markets to force their hand. Either way, the silence is telling. The third signal is the behavior of foreign central banks and their holdings of U.S. Treasury securities. According to data from the Treasury International Capital System, foreign official holdings of U.S. Treasuries declined by $127 billion in the fourth quarter of 2025. That's the largest quarterly decline since the first quarter of 2022. China reduced its holdings by $43 billion, Japan by $31 billion, and Middle Eastern oil exporters by $28 billion. This is significant because foreign central banks have been one of the largest marginal buyers of U.S. debt for decades. If they're pulling back, it means the Treasury has to find other buyers, which means higher yields, which means more pressure on the repo market as primary dealers struggle to finance larger auction sizes at elevated rates. The fourth signal is the credit markets. Credit spreads, the difference between corporate bond yields and Treasury yields, have been widening steadily since the start of 2026. Investment-grade credit spreads are now at 142 basis points, the widest they've been since the regional banking crisis of March 2023. High-yield spreads are approaching 485 basis points, levels not seen since the COVID panic of 2020. This tells us that credit markets are pricing in higher default risk, which means lenders are pulling back, which means less liquidity available for corporate borrowing, and when corporates can't borrow in the bond market, they turn to banks for credit lines. And when banks are already stretched in the repo market, that creates additional stress on the entire system. The fifth signal is what's happening in the overnight index swap market, where traders bet on the future path of the federal funds rate. As of February 12th, the OIS market is pricing in a 78% probability of at least one 25 basis point rate cut by the Fed before the end of the third quarter of 2026. Just 6 weeks ago, that probability was 23%. The market is telling us that it expects the Fed to pivot from its current policy stance because something is going to break. And history tells us that when something breaks in the financial system, it usually starts in the repo market. These signals are not isolated. They are interconnected, and they are all pointing in the same direction. The system is under stress, liquidity is tightening, and the probability of a policy response is rising rapidly. So what do you do right now? First, you need to assess your current portfolio allocation and your liquidity position. If you have significant capital tied up in illiquid assets, long-duration bonds, or leveraged strategies, you need to reduce that exposure immediately. In a liquidity crisis, the assets that perform worst are the ones you cannot sell quickly or that require margin financing. The assets that perform best are the ones with deep liquidity and no counterparty risk. Second, you need to build a position in physical precious metals if you haven't already. This is not a speculation. This is a hedge against systemic risk and liquidity breakdown. The allocation should be meaningful, 15 to 25% of your investable assets at minimum, and it should be held in physical form outside the banking system. Work with a reputable dealer, take delivery or use a fully allocated storage solution, and avoid paper gold products that are part of the rehypothecation chain. Third, you need to establish a core position in precious metals mining equities. This is your leverage play, the asymmetric upside if the repo market crisis escalates and forces a Federal Reserve pivot back to easing. Focus on quality, diversify across multiple producers and jurisdictions, and be prepared to add to positions on weakness because the sector will be volatile. Fourth, you need to maintain liquidity in short-duration Treasury bills or money market funds that invest exclusively in T-bills. This gives you dry powder to act when opportunities emerge, and it protects you from being forced to sell at the worst possible time. Keep 20 to 30% of your portfolio in this bucket as a tactical buffer. Fifth, you need to reduce your exposure to credit risk and leverage. If you hold corporate bonds, high-yield debt, or equity in highly leveraged companies, understand that those positions are at risk in a credit market seizure. You don't need to panic sell, but you need to stress test your holdings and be prepared to exit if conditions deteriorate further. Look at debt to EBITDA ratios, interest coverage ratios, and refinancing calendars. Any company with significant debt maturing in 2026 or 2027 that will need to refinance at higher rates is at risk. And finally, you need to stay informed and stay flexible. This is not a set-it-and-forget-it environment. The repo market dynamics are evolving daily. The Federal Reserve's policy response will determine the trajectory of asset prices for the next 12 to 24 months. And the decisions you make in the next few weeks will determine whether you preserve wealth or watch it erode. You need to be monitoring repo rates daily. The New York Fed publishes repo data with a one-day lag on their website. You need to be watching the Federal Reserve's balance sheet, which is updated weekly every Thursday afternoon. You need to be tracking Treasury auction results and primary dealer positioning. And you need to be following credit spreads across investment grade and high yield markets, because they will give you early warning when stress is spreading from the repo market into the broader credit system. Before we wrap up, I want to ask you a direct question, and I want you to answer it in the comments below. Do you believe the Federal Reserve will intervene before the repo market completely seizes, or are we going to see a full-blown liquidity crisis before they act? I'm genuinely curious to hear your perspective because the debate in the macro community right now is intense. Some analysts believe the Fed is already preparing behind the scenes and will step in at the first sign of systemic stress. Others, myself included, believe the Fed is trapped between inflation concerns and financial stability and will wait too long to act, allowing the crisis to escalate before they're forced to intervene with even more aggressive measures. I want to know where you stand. Drop your answer in the comments, and let's get a real conversation going. And here's the final piece. If you found this breakdown valuable, if you understand that what we just covered is information you will not get from CNBC, Bloomberg, or any mainstream financial outlet, then I need you to do two things. First, smash that subscribe button and turn on notifications so you don't miss the follow-up videos as this situation develops. I'm going to be tracking repo rates, Federal Reserve policy, precious metals, and credit markets in real time, and you need to be plugged in. Second, share this video with anyone you know who cares about protecting their wealth. This is not the time for gatekeeping information. This is the time for community, for education, and for preparation. The repo market is seizing. The collateral chain is under stress. The liquidity crisis is here. The only question left is whether you're going to recognize it in time to position yourself on the right side of the trade, or whether you're going to wait until the market forces you to act at the worst possible moment when liquidity has dried up and prices have already moved. I'll see you in the next one. Stay sharp, stay prepared, and stay ahead of the curve.